So, hello guys, we are going to discuss today unit number 4, and this is the new section. We are going to start with corporate finance. Okay, and there are almost 5 units are there for the corporate finance section. Okay, we are into unit 4 today, unit 4, 5, 6, 7, and 8. So these 5 units are 20% of your exam actually. Okay, it has 20% weightage. So here we go in unit number 4, which is the which is types of securities. So here we will talk about bonds, okay, stocks and dividend. So these three topics are there. So I'm starting with the bonds first. What are the bonds? So here we go. Just in simple words, guys, for example, as a company, if you want to raise a loan, okay, as a company, I'm saying that you want to take a loan. So you got two options. So you can take a loan straight away from the bank, like in the traditional way, like you can provide some assets as a security and you can raise your amount, or you can raise the loan. Very simple. Okay, the second way is what we can uh, take the loan from the public at large also. Okay, generally when as a company we raise funds from the company, from the public. So companies, they generally issue bonds. Okay, so bonds is what I'm going to talk about. Now, the question is that what is bond? Okay, so simply, guys, here we have a simple definition. First, I'll just explain. So, guys, actually, it is going to be a contract. Okay, between what? Between two parties. Definitely, one party is the borrower, and borrower is generally is the company, and second party is going to be the investors, or I can say the lender. Okay, so like this could be a public also, even it could be a financial, any financial institution also. Okay, because sometimes financial institutions like banks, insurance companies, even banks, they also invest in the bonds. So now, guys, it is going to be a contract. Okay, this contract is also called indenture. Okay, this agreement is also called indenture. Now if you will look, if we will understand what's generally written in this indenture or in this contract, so they will write like what is the face value of the bond. Face value is also called par value. Okay, it's also called nominal value as well. And second thing, it could be written there that what is the coupon rate. Coupon rate is also called interest rate or stated rate. Okay, actually this is the rate of interest which the company will pay. Okay, and other things can also be written here. It could be it could have information about the maturity period also. So maturity period means say what, like after how many years the company will take their bonds back. In simple words, for example, if today company is issuing the bonds, okay, for 5 years, let's assume bond life is 5 year. Okay, so now for 5 years, definitely every year or semi-annually company will pay the interest, but at the end of fifth year company will return their face value also. Okay, so the maturity period actually it is the duration of the bond. Okay, so then there could be some other covenants also. Okay, covenants. Like covenant means, say covenant is just a word. Actually, this stand for like terms and condition. Like whatever terms or conditions are there, so it will be written on this. For example, sometime you know the borrower may agree to certain conditions. For example, borrower may agree that maybe in future he will not raise further loan for specific period, or maybe he will restrict the dividend payments to the shareholders, or maybe he will maintain certain ratios like profitability ratios, or liquidity ratios, or maybe whatever ratios he may agree through this contract, that he will maintain this ratio up to the certain level. So generally this information is written there, and company definitely signature or stamps is also there. Now the question is, we need to understand, this is what is general idea I have given to you. So now when as an investor when you buy the bonds, actually you are lending money to the company. Okay, for example, if bond face value is $1,000, now face value mean to say whatever is written on the face of the bond, that's face value. It's also called nominal value as well. Okay, so as an investor, for example, if you are buying bond for 1000, let's assume, okay, so it means today you are investing $1,000, and in future, like at the end of the maturity period, definitely this money, whatever you invested, you will get it back also. That's the principal amount. But apart from that, you will also get interest every year or semi-annually. So now this is the contract, okay? So that's called bond. Now we are going to go through what's the definition, how it is explained. So now, guys, here they're trying to tell you that bonds are the principal form of long-term debt financing because it is actually a loan. So that's why it is a debt financing, and generally it is for longer period. Okay, longer period means, say, I'm not saying it's only for longer periods. It could be for medium period also. Okay, it could be for longer period also, like maybe generally in USA, if the duration is less than 3 years, we call it short term. Okay, if duration is between 3 to 10 years, we call it like medium term. Okay, and if duration of the bond is greater than 10 years, so we call it as a long term. Okay, this is what I'm trying to tell you. So here they are saying that bonds are the principal form of long term debt. Okay, so generally it is used for long term. Okay, and definitely for the corporation, because companies can issue the bonds, and even the government bodies can also issue the bonds. If you heard about that, in different countries, government bonds are also available in which you can invest. Okay, like these bonds are issued by government, so that is called government bonds. Now the question is, this bond, which is a certificate, you can assume like it's in simple words, you can assume it's like a piece of paper. It could be digital or it could be paper based. So it is a formal contractual obligation to pay, because it's a contract. Through in this contract, what you have to do, you have to pay an amount of money called a par value. Par value means a face value, because if as a company today you are borrowing amount, definitely at the end of 5 years, 10 years, or 15 years, whatever the life of the bond is there, so you will return this par value. Okay, which is also called par value, is also called maturity amount, it is also called face amount. Okay, now, as a company, you will return this money to whom? You will return this money to the holder. Holder means say who, the person who hold that bond. Actually, that is the investor who has invested. Okay, and when you will return this money, that is definitely you will return this money at certain date in future, and that certain date is called maturity period. Okay, then they're telling you in most cases a series of cash interest payment based on specified percentage, okay, called stated rate or coupon rate of the face amount, or at specified intervals. So what it means, they are telling you, as a company, you will not return only the face value at the end of maturity period. No. So during that period, you will also pay interest. Interest is called stated rate. It is also called coupon rate. Okay. So you will pay what at specified intervals. Specified intervals mean to say you will pay definitely, guys, either maybe the bonds could have annual interest rate, maybe you will pay annually, or you may pay semi annually, means every 6 months also. Okay, now here you should remember this, the definition of bond. So how I can say in simple words, I can say bond is the agreement between borrower and lender, in which the borrower is agreeing with the lender that he will return their money plus he will pay the interest. Okay, up to certain period of time. Now that's the definition of bond. Now the next part is, as I told you, on the bond, whatever the interest rate is mentioned on the bond, that is called stated rate. That is also called coupon rate. Okay, please don't mingle these terms. So it's same thing, stated rate and coupon rate. Okay, and now one more question is, so whenever you will calculate the interest, this is a rule of thumb. So rule of thumb, that whenever you want to calculate the interest as a company, because we are studying from company point of view, so how you will calculate, you will calculate face value of bond, whatever face value is given in the question, multiply with the stated rate, which is also called coupon rate. Okay, for example, if bond is having a 1000 face value, $1,000, you will take $1,000 times, let's assume 10% interest rate is there, which is stated rate. If you will multiply, so $100 is going to be your interest. Okay, if this rate is annually, so definitely this is the interest which you will pay annually. Okay, so interest is always calculated on the face value. And number two things, if you will notice here, I have used here face value of the one bond. Okay, so and I multiply with the 10%. But if you will take total face value, total face value, okay, total face value, how you will calculate? You need number of bonds, and you will multiply the number of bonds. You will multiply with what? With the face value per bond. Face value per bond. For example, I'm saying that face value per bond is $1,000, and there are 100 bonds are there in the market. So 1,000 times 100, it means total face value is $100,000. Now if you will multiply with the stated rate, so this is going to give you $10,000 total interest on all bonds. So idea is very simple. If you will use the face value of one bond, you will get interest per bond. If you will use total face value, so you will get total interest. Okay, so that's the rule of thumb you have to remember. So because why I'm saying that, because in your exam question, three different types of figures can be given to you. He can tell you issue price of the bond, he can tell you the face value of the bond, and he can tell you market value of the bond. I can tell you here simply. Look at here. Let's assume face value is $1,000. He will tell you in the question what's the face value. Okay, but maybe this bond could be issued at $1,000, maybe at par. It can be issued at premium also. Premium means say maybe companies they may charge more than face amount when they are issuing. Okay, so that I'll explain the cases how and when you can charge premium. So it can be issued at par, okay, which is $1,000. It can be issued at premium means say above the par, maybe $1,050. It can be issued at discount also. Discount means say below the par, maybe $980. It could be any figure. So guys, remember here, issue price could be different than face value. I'm saying it is possibility. Okay, then what's the market value? Market value mean to say the value which the value of the bond which currently prevailing in the market. For example, maybe the bond face value is $1,000. Maybe now it's being traded on, for example, 1100. Okay, so now this is the market value. Market value means it's a price, okay, which currently prevailing in the market, which investors will pay if he will buy now. Okay, so that's called the market value. Now, what's the rule? Why I'm explaining these terminologies? The reason is that because whenever you will calculate the interest, so make sure you are using face value of the bond. Never, please, never ever, please don't calculate the interest on issue price or on the market value. Always use the face value, okay? Because market value or issue price could be different than face. Now, guys, this is what I told you. Now, I have already explained to you that what is bond indenture. I have already told you that bond indenture means it is actually an agreement, okay, or it is kind of piece of paper, digital or paper based. So it's a kind of agreement in which all terms and conditions could be not could be definitely terms and conditions are written. Okay, like what's the face value, what's the interest rate, frequency of interest payments, maturity period, okay, uh, covenants, terms and conditions, any terms and conditions. So all the terms and conditions are definitely written on this paper. That's called bond indenture. Okay, now guys, please remember here. I'll explain a lot of words with the passage of time. So now here we go. Here you have to remember this one kind of rule of thumb also. In general, what is general? In general, like this is a general statement. The longer the term of bond, the word term of bond means the duration of the bond, which is also called maturity period. Okay, duration of bond, maturity period, term of bond, it's the same thing. So if they're saying that if a bond is having a longer maturity period, maybe 15 years, 20 years, so what will happen? The higher will be the return demanded by the investors. Return is also called yield. Okay, so please, they are saying that if duration is longer, so definitely investors will ask for high interest or high return. The question is that why? I can just explain in this way. For example, if you are the investor and I'm giving you two options, you can invest for 2 years or you can invest for 20 years. So definitely 20 years are having more uncertainty. You don't know what will happen in 20 years. So it means your money is going to be tied up for 20 years into the business. So definitely you are on the risky side as an investor. So you will demand higher return for this. This is what is your the concept. Okay, so what's the rule would studied here? longer the term of bond, if duration is longer, so the higher will be the return. So investors will demand higher return, okay, to compensate their risk. Okay, now we got it here, guys. Some advantages and disadvantages. So first we are talking about like if as a company you will issue the bonds, okay, to the issuer. Sorry, if you will issue the bonds, so what advantages you will get as a issuer? Please remember, issuer stand for company. The company who is going to, or the company who is going to issue the bonds, that is called what? The issuer. Okay. So we are discussing now advantages of the bonds to the issuer. So the first advantage is that whatever the interest we will pay, that interest is tax deductible. What it means? I can just compare the reason, then you will get it, with you will get it more clearly. So let me give you example. For example, dividend. On shares we pay dividend, right? On stocks we pay dividend, and on bonds or on loan, because bond is the kind of loan, so you will pay the interest. And if you remember, this dividend you will never write as a expense in the income statement. No, it means dividend is not tax deductible because we don't write as expense, okay? Or the tax rules, they don't allow us to record as expense whatever dividend you are making, you are paying, okay? But on the bond, whatever the interest you are paying, you have seen in the income statement, so that the interest is always deducted. Interest expense, which is also called finance charges or finance cost, that is always deducted in the income statement. It means once you will write the interest expense, automatically your taxable profit will reduce. Your taxable profit will reduce, right? Because expense you are showing, you are writing, okay, or you are presenting in the income statement. Once the expense will be written, so profit will go down. Due to that, you will get some tax saving or some tax relaxation. So that's called tax deductibility. So this is what they're saying, that the first advantage is that the issuer will get, okay, tax benefit. Okay, now the next is basic controls of the firm is not shared with the debt holder. Again, this is a second advantage, but I need to compare it with again the stock. Again, for example, the stock, let's see, which is called common shares or common stock. Okay, common stockholder, we will talk about the types of stocks, and this we have already discussed in the part one also. But if in the part two, so definitely in coming lectures, I'll explain these types as well. So common stocks. So guys, in common stock, what we do actually, the common stockholder, they have a right, voting right actually. Okay, they have a voting right. Voting right means that they can participate in decision making process of the company. So that's what is the voting right. Like whatever the major decisions are there, for example, in election of the board of directors, in maybe removal of the board of directors, or maybe in dividend announcement, okay, maybe in the merger and acquisition, whatever all important decision making is there. So the common stockholders, they participate in such meetings. But the question is that as a bondholder, okay, as a bondholder, can you participate? No, we cannot participate because we don't have voting rights. Okay, and now you have to remember one thing here, which is very crucial. If a company will hold, or if a person will hold, or a company will hold more than 50% of the voting rights of any company. For example, company A holds more than 50% of voting rights in B. So it means A is considered as, kind of, I would say, the decision maker. Okay, I'm not using appropriate word, a technical word. No, I'm just saying that anyone who who will have more than 50% voting rights, so it means he would be considered as a major decision maker. So now the question is that when company issues stocks, so we might have a threat that you may lose the control. Some other person or other company can get more than 50% if you will issue shares blindly. But the question for the bond is, do we have any voting right attached to the bonds? Answer is no, we don't have any voting rights, okay, which is attached to the bonds. No. So it means if you are issuing bonds, we don't need to worry that we will lose the control over the company. Okay, that's the second advantage. Now, guys, here we go. The third, we are discussing now what are the disadvantages of bonds to the issuer. Again, like the company, that is issuing bonds, what are the disadvantages? So here we go. So first point I'm going to talk about, unlike returns on equity, return on equity like a dividend payments. Okay, in the payment of interest and principal on debt is a legal obligation. That's important point. So the point is, let me explain this way. If you issue the shares, stocks, so if you will not pay any dividend, so you, it's not your legal duty to pay the dividend for common stock, I'm saying. Okay. So for example, if company is in losses, so company may decide, okay, we don't have money, so this year we will not distribute any dividend. It's fine. No one can force you to pay. But if you have taken a loan, think about loan, think about yourself. Like if you have taken loan from the bank, now you have to pay the interest. If you will not pay, maybe bank can come to you, can sell your assets, whatever assets were kept as a security, so that those assets can be sold very easily by the bank. So it means, in case of debt, in case of bond, so it is going to be your legal obligation. Okay, it's a legal commitment. Even you are in losses, even you are in trouble, even you are in financial distress, whatever, so you have to make payment. Okay, so if you will not make payment, what will happen? So the bank can sell your assets, those assets which definitely which you have given as a security against the loan, so those assets can be sold. So that's called insolvency also. Okay, so insolvency problem can also arise, okay, in case if you will default, or if you will delay the payments, or if you will have a cash flow problem, so this problem can be raised. So here we discuss 2 points actually. The point number one is what, it's a legal commitment, even you are in losses, so you will definitely you have to pay your interest and principal amount. Okay, and if you will not pay, another point we discussed, so you may become insolvent also. Okay, then second disadvantage, the legal requirement to pay debt service raise a firm risk level. Okay, so we have to understand now this word debt service. What is debt service? Okay, debt service means to say, like when as a company or even as an individual, when we borrow the money, we have to pay the interest. So the interest payment is called debt servicing cost. Okay, so they're saying that the legal requirement to pay debt service, whatever the interest, raise firm's risk level. Yes, because even if you are in losses, you have to pay. So definitely a company that will take or that will raise more loan, okay, definitely that the risk for that company will be higher. Okay, for sure. Now that is why this is also general discussion. This point I'm explaining now. What is this point? Have a look here. So for example, this is the company A. Company A has a lot of, for example, loan, and loan amount has increased over the period. Now think about the shareholders. As a shareholder, if you are a shareholder of this company, not a bondholder, shareholder, so how you would you think? Now you can think this way, okay, this company is taking loan, okay, and it is increasing year by year. So now you are thinking that, okay, whatever the company profit will earn, okay, so those profits will be paid definitely as interest first, and maybe there will be nothing left for you to get dividend. So this is what I'm trying to tell you here. So whenever the company debt burden, the company's debt burden will increase. Whenever it will increase, shareholder risk will also increase, and to compensate the risk, shareholder will demand more return, which can result in decline in the price. So now this is the statement what I said. Okay, what I said, if your debt burden will increase, shareholder risk will increase. Once shareholder risk will increase, to compensate the risk, shareholder will demand higher return. This is what I said. And once the shareholder will demand higher return, company stock price goes down. Why? So company stock price go down. Why it goes down? So here we go. So I'll give you example. I'm not sure if you understand this formula. If you don't understand, it's absolutely fine at this play at this time. Okay, but it's just extra concept in context to this topic. Okay. Now, guys, look at here. For example, how company stock price can go down if the shareholders will increase their desired rate of return or desired return. Okay, so here we go, let's have a look. Normally, guys, what we do when we calculate the stock price in finance, we always calculate the present value of dividend. Guys, my point is not to teach you here now right now to how to calculate the stock price. No, it's just the idea. I just want to explain why stock prices can go down if the shareholders will demand high return. So here we go. The normal formula to calculate the price, stock price. So this is how we calculate future cash flows, which is the dividend which you will pay. That you will divide always with the required rate of return. So if you will divide dividend with the required rate of return, actually you are getting the present value of future cash flows, and that is considered as a price. Okay. Now here we go. Let's have a look. For example, there is a company. Okay, the company is paying $5 of dividend numerator, and the shareholders required rate of return is 10%. So how you will calculate the price? So 5 divided by 0 point or 0.10 equals what? $50 the share price. Now here we go. If the shareholders will increase the return from 10% to 12%, so look at here, amount of dividend is same. For example, divided by required rate of return is 0.12. So now the stock price will reduce automatically $41.67. Okay. Now, what we noticed that if shareholders return from 10 to 12%, if the amount of dividend is constant, so stock price will reduce from 50 to 41.67. This is what is the point which is written here. Okay, this was only theoretical point, but just I try to give you basic idea. Now, now, guys, the amount of debt financing, this is another disadvantage. The amount of debt financing available to the individual firm is limited. The reason I can tell you. For example, think about yourself. If you got your assets only, you got only house as your asset, for example, you don't have anything else. And house value, as an individual, I'm telling you, your house value is $1 million. And if you will apply the loan against this house, no one will give you more than $1 million loan, right? So the most of the time banks they will offer you maybe 50% or 60% or maximum 80% of the house value. It means if the house value is $1 million, so you can get $0.8 million as a loan. Okay, so that is why they're saying that amount of debt financing available to the individual firm is limited. Why it's limited? Because companies they always have limited assets, so you cannot take the loan more than assets figure. Okay, I'm not saying it's 100% sure you cannot raise more than asset figure, but generally it happens. Okay, now guys, here we go. I have already explained to you this word also, which is a debt covenants. Okay, what's the debt covenant, guys? So debt covenant, I told you, I told you at the start. Actually, these are the restrictions or conditions. Okay, or protective clauses again, the terms and condition whatever is written. So these are the restrictions or the protective clauses that are imposed on borrower by a creditor means by lender, okay, in a formal debt agreement or an indenture. So what it means, I have already told you. Maybe I'm let's put into this way. For example, I'm borrowing money from you. I'm a company. I'm borrowing money from you. Okay, maybe $1 billion. And now at the time of lending, so what you are saying, you told me that you cannot raise further debt. I am agreeing to that. Okay, I'm saying okay, I will not raise further debt. And you also told me that you will pay interest every 6 months. It won't be delay. I agree to it also. Okay, I agree to it also. Okay, and then you told me you will not pay dividend for next 3 years. I'm asking why. You are telling me because we want our payments. Then on this condition we will give you loan. I agree to it also. Okay, now then next you ask me I have to maintain my profit, like let's say 20%, 30% or ratio, certain ratios I have to maintain. I'm agreeing to this also. So these all are called debt covenants. Debt covenant means the terms and conditions or the restrictions or the protective clauses which are included in the agreement, are included in the indenture. That's called debt covenant. And obviously, if the debtor, mean to say the borrower, if breaches the debt covenant, if he will breach the covenant or the conditions, so the debt becomes due immediately. So it is considered as a default. Okay, because or the breach of contract. So definitely, if there is a breach of contract, so the whole amount maybe you have to pay in lump sum. Okay, that's the what is the idea, guys. I hope so it is clear. And then there is another point regarding this bonds, because still we are discussing bonds in different words. I'm explaining only. Okay, so we got it here, the call provisions also. What is call provisions? Okay, provision means again it's a clause. Okay, I'm just going to explain here what is call provision. Calls provision allow the bond issuer means the company, to exercise an option to redeem the bonds earlier than specified maturity date. Okay, what it means. For example, there is a bond and bond life is 10 years, but we have written as a clause, as a point, we listed a point in our bond that company, okay, even the bond life is 5 years, let's assume interest rate is 5%, bond life is 10 years, interest rate is 5%, it's written. But there is a one extra point is written in the indenture that the company can call back, for example, after 5 years also. Okay, company has this option, actually option mean to say choice. The company can call it back maybe after 5 years, or maybe after 3 years, or after 6 years, whatever duration you can decide. Okay, so and company will pay you this much amount. So company will repay you this much amount. So that's called call provision, actually. And now the question is that why companies, they include this call provision into I would say, into the bond indenture. Why? The reason I'll tell you. For example, you have issued a bonds for 10 years and rate of interest is 5%. Okay, you have included the call provision for 5 years. Now what happened after just 4 years or 5 years or after 3 years? In the market, interest rates are 2% only, but how much you are paying? You are paying 5%, for example. Now this that is not good for you, whatever the amount you are using, because it's expensive for you. So what you want to do now, maybe you want to call these bonds back after 5 years, and then you can issue the new bonds, or maybe you can take a loan from the bank at lower rate. So this is what, that's the reason. If a company, most of the time, if they have idea that maybe interest rate may decrease in future and they don't want to carry with this expensive loan at 5%, so they can cancel it and they can go for the further loan at 2%. So that's called call provision. I told you call provision, what it is, that company is having an option, okay, to redeem the bonds before the maturity date. That's called call provision. And I told you the reason also why companies they do this. Okay, then guys, there is another concept. So that's called sinking fund. Okay, so this you also need to understand. A bond indenture may require the issuers. The bond indenture may require the issuers, means the company, to establish and maintain a bond sinking fund. This is the term now. Sinking fund is what? I can just give you this way example. For example, guys, you took a loan of $10,000 and you agreed that you will return this after 10 months. You will return this after 10 months, but now, or after 10 years, for example. I'm just keeping here 10 months, okay, as example. Loan amount is 10,000. Your duration is 10 months. So what you are going to do, you are going to open, just as example, you are going to open a bank account. Okay, bank account you are going to open, and what, every month you will keep 1,000 into this bank account as a saving. 1,000 plus 1,000, 10 months you will keep this saving. Okay, obviously after 10 months this will become $10,000, and this $10,000 you can use to repay the loan. So actually similar way sinking fund will work. So sinking fund, you can assume it's a kind of saving account for the bank. Okay, saving account for the company. Every year company will keep some amount or put some amount into that bank account, and over the years, cumulatively this amount will become equal to the loan amount, and that amount you can use to repay the loan. That's called the sinking fund idea. So here as example, it's quoted here. For example, a company issues $10 million in bonds. So it's 10 million is the amount of loan due in 10 years. This is the bond's life. It might put $1 million each year into a sinking fund. By the end of 10 years, the fund has enough money to repay the bondholders safely. So that's called the sinking fund idea. Okay, I hope it is clear. So we got a question here. If you will just go through, the question is the call provision. Okay, a call provision in some bond indenture. Indenture, do you remember? Contract, agreement, okay, or paper in which terms and conditions are written. That's your contract. That's also called indenture. A call provision in some bond indentures allows, like what, the question is about call provision. Call provision is what? Allows the bond holder to redeem, not to the bond holder, to the company, to the issuer, to redeem the bonds early by paying a call premium. I didn't say about the call premium anything. Call premium is some extra money. Yes, this you can decide, but it is the option which will allow the issuer, not the holder, not the investor. Bond holder means say investor. but it will allow the company or the issuer. Then they're saying the call provision in some bond indentures allow the issuer to exercise an option to redeem the bonds. Yes, you can. This is the correct option. Before the maturity date, you can exercise this option. That's the correct answer. Now, the call provision again. In some bonds, indenture allows the issuer to pay premium in order to prevent bondholder for redeeming bonds. No, we don't. We don't prevent, actually. We convince them to sell back to us. Okay, this is not the option. Then the D. Again, the call provision in some bonds indentures allow the bondholder to exchange the bonds at no additional cost for common shares. No, that's the convertible bonds, actually, not the call provision. Call provision is what you got a option. Okay, that company can exercise this option. Company can buy these bonds back before the maturity date. That's the call provision. So B is the correct option. Okay, so I hope it is clear. So next now guys, we are talking about here types of bonds. Okay, types of bonds we are discussing here. So guys, here we go. Uh, Different types we are going to go through here, so you need to understand these words also, because as it looks easier, but the questions are really difficult when they test the theory especially. Okay, it's so confusing, I'm telling you. So here we go, types of bonds. So how many types we got? So number one, the first type, okay, from the maturity pattern I'm explaining here. Okay, from the maturity pattern point of view, so the first is the term bond. Term bond is what? It's like that. For example, company has issued the bonds for 10 years. This is the bond life. And company told you at the end of 10 years, at the end of 10 years, the company will return your money and company will take this bond back. So that's called term bond. Like here, what we have, where we have only single maturity date. Okay, which is end of 10 years. Okay, at the end of 10th year, the company will take it back and will repay your money. So that's called the term bond. So we got a single maturity date. Okay, at the end of the term. Term means a duration. Then there is another types that is called serial bonds. Example is also written there. So, but we need to understand what's the serial bond. Serial bond matures in a stated amount at a regular intervals. Okay, so I didn't get it what they are trying to say. I hope so you also didn't get. Okay, it matures in stated amounts at regular intervals. What it means, let me first give you examples here. Here we got example. For example, let's assume we are assuming city of Dubai municipality. Let's assume municipality department of Dubai. They want they wants to raise they want to raise how much? $50 million as a loan. Why they want this loan? Why Dubai want this loan? Maybe to build a new water treatment plant. Okay, that's clear. So they need this $50 million in short. Then what? Instead of issuing one bond that matures in 10 years. Okay, because here with the question I'm explaining also, because if you will raise $50 million, okay, and you will keep one day to repay, okay, maybe end of 10th year, so then it's a problem for you, because 50 million is a huge amount. Maybe you might have a problem at that time to settle this amount, to settle this debt. Okay, that's why what the city issues a serial bond. Serial bond means the bonds with different maturity dates, like that. For example, you are raising how much? 50 million. Interest rate is 5%, but maturity schedule, this is what is the maturity schedule you are providing. You are saying that total loan you need 50 million. You are saying that, okay, 10 million you will redeem, means you will return at the end of 2026. 10 million you will redeem, for example, at the end of 2027. 10 million you will redeem at the end of 2028. 10 million you will redeem at the 2029. 10 million you will redeem at the end of 2030. So that's called actually now the serial bond. See, the loan is 50 million, but you have given, okay, various maturity dates. So that's called the serial bond. In the term bond, I have explained to you that we got only single maturity date, but in serial bonds we got multiple maturity dates. I hope it is clear. Okay, now what is the benefit? Okay, just I'm explaining the benefit of the serial bond. What's the benefit? What? First, the city means the Dubai government avoids a large single payment. Yes, you don't need to pay 50 million together. You can split your 50 million into 10 millions. Okay, investors can choose the maturity date maturity date that fits their needs. Yes, maybe you can buy this bond with this maturity, maybe you can buy bond with this maturity. It's your choice. So it means investors can choose the maturity that fits their needs. Okay, maybe they want to invest only for short period, maybe for 1 year, or maybe for 6 7 years, like that. Okay, it provides another benefit. It provides stable cash flow planning. Yes, as a company, if you will think, so you don't need to pay 50 million as a lump sum amount. No, you can split into 10 10 10, so your planning will be easy. You will not face any trouble, I think so. Okay, so that's called the serial bond. Okay, now, guys, we got here some other types of bonds, and these bonds are characterized, okay, based on the interest rates or interest payments, okay, or interest pattern. So let me tell you here. So there's another type that is called bonds with the variable rate. Okay, what it is, I'll tell you here. For example, guys, there are different types of bonds are there. Sometime you can issue the bonds with the fixed rate of interest. Fixed is what? For example, you issued the bonds for 10% interest rate. Now this 10% is fixed. Whatever, even your central bank is reducing the interest rate or increasing the interest rate. Okay, so it doesn't matter. You will pay only 10%. So that's called what? Variable rate bonds. Oh, sorry, fixed rate bonds. Fixed rate. Okay. Now what's the variable rate? Variable is like that. You are saying that you are issuing bonds at 8% today. You are saying that you are telling to your investors, but if the central bank or the treasury bonds and anything, or the government, okay, if they will decrease the interest rate, for example, if they will decrease the interest rate, you will also decrease this interest rate. If the government will increase the interest rate, you will also increase this interest rate. That's called what? Variable rate bonds. Okay, so variable rate bonds pay interest that is dependent on the market conditions. Market conditions means the rate of interest which will be decided by the government or your central bank, whatever, okay, is applicable in your country. Then, guys, I have already explained to you fixed rate bond also, because bonds which will have fixed rate of interest, whatever the rate of interest is in the market are decided by the central bank. You will not care about that. You will pay just the fixed percentage. That's called fixed rate. Now we got it here, another bond which is called zero coupon. Zero coupon, do you remember? It's stated rate. Coupon means interest. Zero coupon means zero interest, no interest. You will not pay any interest. Then what you will do? This is what I'll explain now. So we got another type which is called zero coupon. It is also called deep discounted bonds. Let me give you idea. So here we go. For example, today company is issuing bonds. So issuing bonds at what? For example, $1,000, $980, for example. And in future, for example, the face value of the bond is $1,000. Face value, but company is issuing at $980. Now look what happened. So it means company has issued 980 or 950. Let's assume 950, because deep discount, like discount should be greater, by the way. Okay, for example, as a company, you are issuing bonds at $950, and the face value is $1,000. What? but but you will not pay as any interest. Okay, for example, this bond life is 5 years. Now what? Today, as an investor, you paid $950, you paid, and after 5 years you will get this face value $1,000. This is what you will receive as investor. So $50 is a gain for you. Okay, is gain for you. But in zero or deep discounted bonds, you will not get any interest, so only you will get the capital gain. Capital gain is what you invested and what you received. That's your capital gain. So interest is what you do, that is the frequent, payments annually or semi-annually. So you will not get any interest, only the capital gain you will get. So that's called what is your zero coupon or deep discounted bonds. So if you will go through, it's written very clearly. So zero coupon or deep discounted bonds bear no stated rate, means that there is no interest. Okay, thus involves no periodic cash payments. So there is no cash payments because there is no interest. So periodically, okay, so the interest component consists entirely of the bonds discount. So that is what I already told you. The bond has been issued at 950, so that's, and it will be redeemed at 1,000. So you got $50 gain, which how you got? Because you invested $50 less, that was discount to you. That's why it's called deep discounted. Okay, then, guys, we got it here. commodity backed bonds that we also need to understand. Commodity backed bonds, what it is, let me give you example here. Here we go. For example, guys, you have issued the bonds, okay, uh, and the commodity on the back end, like maybe gold, wheat, rice. So that is, let me say this way. For example, you issued the bonds at 10%. Okay, and your this interest rate is going to link, let's say, with the gold price. For example, today gold price is $1,000 per ounce. I'm just giving example. Okay, and what's the interest rate? 10%. Now, what will happen if the gold price will go up in the future? So you will also increase the interest. If gold price will go down in the future, you will also decrease the interest. So that's called commodity backed bonds. Okay, so the commodity backed bonds are payable at prices related to the commodity such as gold, anything. Okay, so that's called commodity backed bonds. I hope it is clear. Now we got it here, guys. Another type of bonds. One is called callable bonds. If you remember, I told you callable bonds, which is call provision also. Okay, kind of call provision. Okay. I told you callable bond means, let's say bonds were issued for 10 years, but you have included the clause into the bond indenture that you can call it any time. Okay, the maybe before 10 years, so that's called callable bonds. So callable bonds may repurchased by issuers at specific price before the maturity. Here we got example for that also. For example, the bond is having a face value of $1,000, sorry, $1,000. Yes, coupon is 6%, which is traded rate, also interest rate. Maturity or the duration or the term of bond is 10 years. Callable after 5 years at $1,020. You have written this in the indenture that company can buy it back these bonds at $1,020 after 5 years. So now, if after 5 years market interest rate drop 4% because you are paying 6%, I gave you this example already at the start. Okay, why you are writing this term callable in the bonds? Because if in the market interest rate will go down, so why you are paying 6%? Then you don't need to pay. Take your bonds back and issue new bonds with less interest. That's the benefit actually. Then we got it here, convertible bond also another type. Convertible bonds, guys, it's very simple. For example, today as a company, issuing company is issuing bonds. I'm just giving you example. Okay, for example, you are issuing bonds which are convertible bonds, and you have written in the bond that each $1,000 can be converted. $1,000 means each bond. Okay, can be converted into 20 shares of the company. Okay, after 5 years. Now this is called convertible bond, because sometime company what they do, when they issue the shares, they include the conversion ratio, okay, into the bond indenture. Okay, like what is the conversion? This is the conversion ratio, by the way. So that thousand, I'll explain the formula later with the question. Just in general, I'm telling you. For example, you said every bond means every $1,000 can be converted into 20 shares, 20 common stock of the company. Shares means a common stock. Okay, but after 5 years. Sometime company also give option. He will give you option to convert your bond into shares, or you can take the cash from the company. Okay, or you can take the cash from the company. Now you will see as an investor, if you feel 20 shares are better, it has a more value than cash option, so you will go for the shares. If you think no, shares is not good option, cash is better option, you can go for the cash. But convertible bonds are the bonds which has you know which can be converted into equity securities or into common stock or into shares of the issuer at the option of the holder. This you will decide, you want cash or you want shares. So you are the holder, you will decide. Okay, okay, this is what that this kind of bond is called, what? Convertible bond. I hope so it is clear. Then we got it here, another type of bond that is called bond mortgage. Okay, from securitization point of view, I'm going to explain now. A security is what, guys? Whenever we take loan, definitely we have to give some assets as a security. That's called securitization also. Okay, but here I'm going to talk about mortgage bonds. Mortgage bonds, okay, which is also called sometimes asset-backed securities, etc. So, guys, remember here, mortgage bonds are backed by specific assets like real estate. Okay, for example, I can just make it very complicated also, this mortgage bond. Okay. If I'll explain the more detail, but you don't need to bother about that such critical points. So just keep in mind that if you are taking, if you're issuing bonds, and on the back end, the security which you are giving, that is real estate assets, that could be building, okay, etc., land and building. If real estate asset you are giving as a security and issuing the bonds, so that is called mortgage bonds. Okay. Because under this term, under the mortgage bonds, we have a different terminologies. We have CDOs, we also have, mortgage backed securities, MBS. Okay, so different things are there. So but in keep in mind, if any bonds which is issued against real estate asset is the security for that, that is called mortgage bonds. Okay, so then we got it here, debentures. Okay, remember here guys, debentures, please remember, first of all, debentures are backed by issuers' full faith and credit. Let me stop and tell you in simple words. Guys, debentures, a kind of bonds. It's a kind of bonds, but these are unsecured. Unsecured means say there is no security, there is no building, there is no land as a security, there is no equipment as a security. No. So these are totally unsecured. But the companies can issue these bonds also. For example, as example, if the government, or if Unilever, or if a Tesla company, maybe if they will issue unsecured bonds, now the company will have a faith on the Tesla company, that this company is highly reputed company. They are not going to eat your money, so that's why your money is safe. Even they are not giving you any security, so still you will be interested, or you will be willing definitely to invest into the Tesla. So that is what is the actually the debenture. Debenture means say what, these are unsecured, we don't have any specific collateral, we don't have, only you have a faith on the borrower that he will return your money. Why? Because the borrower is a credit worthy organization. Okay, so that's called debentures. So debentures are backed by issuers full faith and credit, but not by specific collateral. Thus debentures are riskier to investors than secured bonds, because you don't have a security. So if you don't have a security, so you are just having faith on the borrower that he will return your money. It means you are taking risk actually. That's why debentures are generally having more interest than secured bonds. Okay, because we don't have a security. Unsecured bonds will have more interest. Okay, guys. So then we got it here. Equipment trust bonds. This is another type of bond which I'm discussing now. What is equipment trust bonds, guys? Equipment trust bonds are secured by a lien on a specific piece of equipment. I will give you example. For example, guys, uh, it's about equipment. Equipment is what, such as airplane, railroad car, etc. Okay, I'm just giving example here, guys. For example, mostly transportation companies. Okay, they, if they want to raise a loan, because their equipment, their assets are very expensive, like aeroplane. Okay, like maybe the railroad cars. Okay, trains, I mean to say. Okay, so these are very expensive, so what they can do, they can give these assets as a security and borrow the money. That's called equipment trust bonds. Okay, and mostly these equipment trust bonds are used by uh, transportation companies like airlines, railroads, shipping companies, etc. Okay, that's equipment trust bonds. Then we got here income bonds. Please remember here, income bonds, I'm going to tell you, this is from a repayment point of view. For example, guys, it's like that. For example, as a company, okay, we are issuing bonds, and these bonds are income bonds. Okay, income bonds. So what it means, now I have issued the bonds, but I have written in the bonds, if I will earn a profit, I will pay you 10% interest. If I will not earn a profit, if I don't have any profit, I will not pay you anything. That's called income bonds. Income bonds pay interest only if the issuer earns the interest. Okay, or if issuer earns the profit, that's called income bond. Here I am going to explain explain with the help of example. For example, we got ABC Railways is emerging from bankruptcy, like it was near to bankrupt, for example, and issues 1,000 dollar income bonds, like this is the face value of the bond, with a 6% coupon rate. Rate of interest is 6%. If ABC Railway earns enough profit this year, it will pay, let's assume, because interest is 6%. So 6% of the face value, it will be $60. Okay, so if ABC Railway earns enough profit this year, it will pay $60 per bond. If the railway company does not earn enough profit, no interest is paid because it's income bond. If you will get income, you will pay. So it means these bonds are backed by income of the specific source. If you will not have a profit, you will not pay. If you have a profit, you will pay. If at the maturity date now, ABC Railways repays 1,000 principal, definitely at then you will return face value to the bondholder regardless of the interest payment. Because if you are into losses, so you don't need to pay interest because it's an income bond. You don't have income, so but still original amount, the principal amount you have to return. Okay, then we got it here, revenue bonds. It's I would say another version of income bond, but here, for example, in revenue bond, let's assume I'm telling you lend me $1,000 and I will invest into, for example, ABC business. Okay, whatever the sales I will generate from the ABC, of that, for example, 6% of the sale, uh, or if I will have a sale, I will use this source to pay you the interest. Okay, definitely in bonds, interest are there. So interest is always calculated on what is calculated on the face value. That's very true. Okay, but here what we are deciding here revenue bonds. Revenue bonds mean to say here revenue bonds are issued by government or maybe by companies also. Mostly it is issued by government units and are payable from specific revenue source. It's very good example written here. For example, a city or the government builds a toll bridge and issues 10 million dollar in revenue bond. So they took the loan of 10 million through the revenue bond to finance this construction. Okay. Now the toll fees collected from the vehicles using the bridge are used to pay interest and principal amount. So that is what is income bond. Oh, sorry, the revenue bond. So what's the main difference? In income bond, profit is distributed. In revenue bonds, sale is distributed among the bondholders. Okay, we got something else also, guys. Only these two lines are written in your book, but I'll try to explain. So there is one more thing which is called subordinated debentures. But there is another word that is called second mortgage bonds. So please remember these both bonds are junior securities. You have to remember this word junior because there are two kind of things: senior securities and junior securities. So what it means actually, first understand these two words. Senior security means say in case of default, for example, once the company's asset will be sold, so first they will make payment to the senior, debt holder, and then they will pay to the junior debt holder, or first they will pay to the senior security holder, then they will pay to the junior security holder. So remember here the subordinated debentures, I will explain it. The subordinated debentures and the second mortgage bonds are junior securities, okay, with claims inferior to those senior bonds. I gave you example of it. Now here we go. Now, guys, we got it here. What is subordinated debentures here? I just try to explain. So, subordinated debentures means what? It is a type of unsecured bond. There is no security for it. It's totally unsecured. Okay, first thing. Number two, it is a junior security. I told you already what is junior. Junior security means say it is lower in priority than senior bonds because if the company will default, first they will pay to the senior bondholder, then to the junior security holder. How it works? If a company cannot pay all its debt, okay, the senior debt holders are paid first, and only after senior debt holders are fully repaid, so do subordinated debenture holders get paid actually. First, to whom we will pay? To the senior debt holder. Okay, whenever you will see the word subordinated debenture, because now the question is that how would you recognize? Is it a subordinated debentures, normal debentures, or subordinated bonds, normal bonds? So guys, it is clearly written on the bond indenture actually. Okay, you should think before investing, you should read it. Now, how investors know this? What is the next point? That this which bond you are buying, you are buying. So the bond indenture legally, which is a contract, clearly states whether the bond is a senior or a subordinated. Okay. So and here investors can check the indenture before buying to see the priority of claims. Now, risk and return, definitely these junior securities are more riskier than senior. So that's why the company generally they pay high interest on these kind of securities. So that's what is the subordinated debentures. Here we got example. For example, a company owes 1 million to senior bondholders and 500,000 to subordinated debentures holder. Okay. Now next, if company can only pay 1 million, senior, let's assume company has only 1 million. Let's assume company is going to wind up, they got only 1 million through the sale of assets, and now they want to pay. So only senior bondholder will get full payment here. Nothing will be left for subordinated. Or if company sold asset for 1.2 million, so then 1 million will be paid to the senior, only 0.2 million will be 0.2 million will be paid to the subordinated debentures. Okay, this is how it works. Then we got it here another thing which is called a second mortgage bonds. Okay, what is second mortgage bond? So again, I can just say in simple words. For example, you got a building, you are taking loan, you took loan, first loan on this building. Simple example I'm giving you, okay, to understand this. Okay, so the first, let's assume you took first loan against this building 500,000. Again, you took another loan against the same building. Just for the sake of simplicity, I'm giving you this example. Okay, for example, second loan you took 2,000 against this building. Now this is first mortgage you are saying. This is second mortgage you are saying. Now if company will default, this building will be sold. First they will pay to the first mortgage holder and then they will pay to the second mortgage holder. That's what is second mortgage bonds. Okay, they're saying what it is: a bond secured by a specific asset like a building, but behind a first mortgage. So in case of default, first payment will be made to the first mortgage holder, then to the second. Priority. They're saying consider junior security because second mortgage is juniors, so first mortgage is senior. Considered as junior security because first mortgage bondholders are paid first. Okay, now the question is how it works. I give you rough idea, rough example here. How it works: if the company defaults, the asset is sold. Yes, the building will be sold. The first mortgage bondholders get paid first. Yes, we will make payment first to these people, and then second mortgage holder definitely they will get okay the remaining amount. Then how investors know it's a first mortgage bond or second mortgage bond you are buying? So again, it will be written on the bond indentures. So the bond indenture specifies it is a second mortgage bond, showing it is a junior to the first mortgage. Okay, it's written there. Again, these are less risky than subordinate debentures. Why? Because debentures was totally unsecured. At least these bonds are secured, even they are junior in claim, but still they are secured, still they have assets on this as a security. Okay, but they are riskier than first mortgage. Yes, second mortgage bonds are less risky than subordinated debentures but more risky than first mortgage bonds. Okay, and generally they have moderate level of interest. Okay guys, so this is what is the type. Now we have last two types of the bonds. One is called registered bonds, second is called bearer bonds. Registered is what? For it's like a check by name. We have a cross check or check by name. For example, if I'm writing a check for you, let's assume, okay, if your name is written, only you can take that money, okay, into your bank account. So similar way the registered bonds will work. So the person who is registered in the company's record, only he will get the interest. Even I hold that bond, I will not get if I'm not registered with the company. That's called registered bonds. So registered bonds are issued in the name of the holder. Only the registered holder may receive interest and principal payments. Now the bearer bond is like that. For example, you got a check, on check it's written cash, it's not by name, it's cash check. So if I will have that check, I can get the cash. If you will have the check, you can get the cash. That's the bearer bond. Bearer bonds are not individually registered, no. Okay, interest and principal are paid to whomever presents the bond or the interest coupon for the payment. Now the question here, whoever will hold that bond, he will get the interest. That's the main idea. Now the question is that, think if company is having a 5 million investors, 5 million bond holders who have bearer bonds. Now maybe first day 1 million people came, next day 500,000 people came, third day again 500,000 people came to take their money. It's very difficult, right? Because the condition is whoever will hold that bonds, he will get the payments. So how company will manage? It's totally messy. The how the company will manage, companies generally they hire third parties to do this. Whenever the time will come for the interest payments, so those third parties will provide the services like that. Okay. So guys, this is what all about we discussed about bonds and basic things here. I just want to show you. Let's do one question here. They are saying that debentures. What are the debentures? It's theoretical questions. Debentures, because we didn't discuss any calculation so far. Debentures are what? A form of lease financing? No. Debentures are subordinated. Okay, subordinated debentures were there and rank behind convertible bonds. Okay, so I didn't discuss who will rank first, who will rank second. That we'll see. So far we didn't discuss, but we'll discuss in future. Then bonds, the benches are bonds secured by full faith and credit of the issuing firm. Yes, you have just faith on the borrower that he will return your money. You don't have any specific collateral. Okay, so that's correct option. D. Income bonds. No, debentures are not income bonds. Income bonds are totally different. So income bonds that requires interest payments only when earning permit. No, debentures are not like that. That's the income bond is separate thing. Debenture is separate thing. Okay, is that clear, guys? I hope so it is clear. Thank you so much, guys. The rest of the bonds we will talk about in the next class. If you have any question, you can ask me.